It's a great pleasure for me to join you. I absolutely agree with what Professor Chin was saying earlier. Fintech, AI, big data in finance and in business disciplines in general is really an exciting area to work in these days. I've been exploring a number of applications of AI models together with Gavin Jingyu as well. But today, I thought it's actually a good time to share with you some research that I've been pursuing lately on tokenomics and blockchain economics, or even more broadly, Web3. This morning, I was actually receiving a newsletter talking about how Web3 is supposed to save the internet, but it really has a long way to go. And I'm actually going to show you some related findings that we have. I'm just going to share my screen here. I trust you can all see that. So instead of focusing on one paper, I thought it would be nice to provide a general introduction to this area of research. I'll still single out one paper that I've been working on related to staking for illustration. But overall, I do want to introduce the various classes of tokens. Not all tokens are created equal. They serve different economic functionality, and it's important to know the distinction. And given these different categories of classifications of tokens, how do we think about valuation or pricing? Are they all bubbles? Are there fundamentals to speak of? Is there a big difference between static versus dynamic models in the space? How's the regulation is going to change that? And in the DeFi space, as well as in basic blockchain consensus protocols, many of you have heard of staking. It could happen at base layer for proof of stake as an alternative to proof of work cryptocurrency mining. That's currently underlying the technology for Bitcoin and Ethereum, but it's not very environmentally friendly, and there's definitely a lot of debate and attempts to improve upon that. Proof of stake is one example, but there are also DeFi level staking, which simply means you are locking in certain value into a smart contract, into a protocol. It could be for providing liquidity of a DEX. It could be insurance protocol. It could also be just enhancing the overall security of the system, but happening at layer 2 or even higher layers within these ecosystems. And one common theme throughout these discussions is a lot of the study and mechanisms are very related to monetary policy in general. So if you are someone working on monetary economics or macro, there's actually quite a number of applications of what we already know from central banking and various designs of monetary policy across the globe. So I do want to make that link. Safe to say, overall, this is a great time for economists to get involved. It's not only about the technical side, it's not only about engineering, it's also about how we effectively translate economic knowledge and principles into technology. So that's a long introduction. Let me see if I can move my slides here. Okay, perfect. So this overall rise of tokens or cryptocurrencies or digital assets has been ongoing for, I would say, 1 or 2 decades, even before the birth of Bitcoin. Overall, we have a trend of digitization. There's increasing demand for peer-to-peer interactions, on-demand economy, gig economy, where today I could be a car driver, but tomorrow I could be a passenger, right, for a ride-sharing app. Blockchains as a underlying technology is just providing slightly more decentralized record keeping. It's a ledger book, a database, if you wish to call it. And it is fueling the development of decentralized finance. Cam Harvey and co-authors actually have a very recent book on it, a great introduction. I highly encourage everyone to look into that. But how do we think about different types of tokens? The SEC, the regulatory body in the US, would put it into securities versus utility tokens, which is a very coarse classification. And more could be done. It's an initial step. If you go along the technical specifications of coins or tokens, coins are associated with primary chain, tokens are higher layer. These are not very useful to economists or even to regulators. What would be useful is to think about the economic functionality of tokens. So what are the categories? Well, in a few articles, my co-authors and I have been putting tokens into 4 different categories based on their economic functionality. The first one would be general payment token. These are cryptocurrencies or digital currencies that are trying to compete with money. Bitcoin will be an example. Ethereum is kind of in both of the first 2 categories. I'll talk about Ethereum in a little bit. Central bank digital currencies for sure. China's DCEP, now called ECNY, is definitely something that's competing with money for general payment. And stable coins, if you've been following what's happening with Terra Luna, so on and so forth, there are different ways of achieving stability. You can use collateralization, that's what Tether does. You can use open market operation. That was what Basis was trying to do before they were stopped by the SEC. And Terra Luna uses a dynamic algorithm to achieve stability. These are issues I think central bankers have thought about for a long time. So it's not completely new. There's no perfect solution. That's why we're seeing that it's actually pretty hard to achieve stability, purely relying on some sort of algorithm. Of course, the algorithms can be improved further. So that's one category. The second category, platform tokens, is a category that my co-authors and I have worked on quite a bit. Here, tokens are utility tokens, and one important utility is used as a means of payment or transaction medium on the platforms. And the platforms are typically providing specific utilities. For example, Filecoin will be decentralized storage, right? You can view it as decentralized Dropbox. Dfinity will be decentralized computation, cloud computation, but in a more decentralized manner. Over there, there's, I would argue, quite a number of interesting economics. Some are more related to asset pricing, but others are actually tied closely to what we know about corporate finance. And the fact that you can issue tokens at the platform and firm level makes things very interesting and different. Okay. The third category is actually product or ownership tokens. These tokens are typically not used as means of payment. They are essentially ownership to future products, future services, digital art forms. You know, my flight mileage points will be a form of ownership tokens. By the way, these tokens do not have to use blockchains as a ledger, right? There could be centralized ledger. Google or United Airline could introduce their own tokens. So many of the economics do apply. Where blockchain really comes in is it potentially gives you some additional transparency as well as commitment to how things are going to operate. Just as we know, central bankers would like to explore Taylor's rule. Can they commit to that? Typically not. But in many of the startups that we are observing in the blockchain space or Web3 space, that's a possibility. Okay. And the fourth category is simple, is tokenization of cash flows. That's something we know how to do, discounted cash flow, and that's definitely something falling into security token category. Okay. So given those categories, you know, we can think about how exactly they play a role. We do know tokens, many of them are not based on cash flow, so they are really serving as hybrid assets. In terms of some functionalities or features, it's akin to commodities, currencies, but in other aspects, especially if you introduce governance functions for some platform tokens, it's getting closer to equities that are giving governance right to shareholders as well. So in in the literature, people have shown that tokens can help accelerate adoption, especially leveraging on the network effect within many digital networks. It can be used as a corporate finance tool to think about a firm issuing their own tokens and designing the supply policy. Traditionally, firms hold some cash or liquid instruments such as treasury bonds just to have the flexibility and slack in managing the firm, right? If there's a great investment opportunity, or if I need to hire people or expand my firm, I can quickly do that without having to go through, let's say, fundraising in secondary market, which involves certain informational asymmetry and agency issues. But now, instead of holding those liquid instruments, firms can hold their own tokens and use these tokens to compensate third-party contributors, freelancers, innovators in the space, investors, right? Through ICOs, through IDO, initial DEX offerings, so on and so forth. But the key difference is, traditionally, firms don't price treasury bonds. They don't price US dollar. But now with tokens, with their own monetary policy, they actually can price the tokens. Okay. If we think about the sources of value for these cryptocurrencies or tokens, when they are providing a certain utility, means of payment is one example. Presumably, the users derive a utility flow, and we need to think about how to value the utility flow. It may not be a direct cash flow, but that utility is valuable. It could be, it enables me to use Filecoin as a platform. Maybe it gives me additional governance right. Maybe it allows me to carry out staking, where I lock some of my tokens in order to earn yield on the tokens locked. Right? It's a little bit similar to bank deposit or CDs, where you put in money or collateral into a system and earn a return corresponding to whatever people are trying to make use of the tokens locked. So that's interesting. And another key distinction from how monetary policy typically runs, at least these days, is that for many token monetary policy, the lever is really on the quantity. You can mint new tokens. You can also burn tokens, right? You can lock tokens through certain staking program. But with the current banking system, typically the lever lies in the interest rate side, right? We control the rate rather than the quantity. There was an episode where we control quantity more, but it's interesting to see which one is going to work better for blockchains and token design. Definitely, we've observed that there's huge volatility in terms of token price returns. And what could be the sources of volatility? Fundamental technology uncertainty for sure, policy uncertainty. As with any emerging sectors, there's a lot of speculation, sentiment, behavioral issues coming in. And because of that, at least in this initial phase, crypto assets are typically viewed as very highly speculative and volatile. Another element that's adding to the volatility is we are in the initial phase where the population is still endogenously adopting to blockchain platforms. And the endogenous adoption is very different from the adoption of currency or cash, right? If I live in the United States, I have to use US dollar. There's not so much of an endogenous adoption of US dollar. Of course, I can leave the country, I can immigrate, but that's happening at a much lower frequency. Whereas for these digital platforms, you can really switch on and off easily. So there's endogenous adoption happening all the time. That's amplifying the token valuation. And the token supply policy, whether it's cyclical or counter-cyclical, is going to matter on the stability of tokens as well. Okay, so today I want to focus on one paper that's related to staking, and where we contribute the most is really we want to figure out the asset pricing implications of staking in Equilibrium. There are some earlier, there's actually one other paper in the space by Fahad, Coase, and Thomas, which is a great article on this topic as well. We differ by looking at both the theory and empirical side, and also they focus more on proof of stake and the distinction between short-term stakers versus long-term stakers. I'll provide a bit more institutional detail on the next few slides. And this particular study involves the application of mean field gain with stochastic control. That's a methodology that has been used in discussions on wealth inequality and macro side. It will be a first application in finance, and more specifically in the crypto space. Okay. So let me provide you a little bit background on staking. So there are two types of staking. The first type is happening at the base layer, the infrastructure layer, where agents or decentralized nodes are trying to create decentralized consensus within the network. So consensus recording of events or transfers of value, exchanges of information within the ecosystem. And there is a large set of protocols that are pan-POS, proof of stake. So how does proof of stake work? Well, if you are willing to stake, basically put your tokens out of your typical usage, when you lock it up as collateral, subjected to risk of losing it. The more you stake, the higher the probability that you get to be the record keeper. You get to record that block and win the block rewards. Right? Ethereum is currently contemplating of a transition from proof of work to proof of stake. That's one type of staking. And overall, the size of stakeable tokens has been increasing. Here I only show you the number ending in last October. I think over the past few months, it has dropped a little bit, but it's still quite sizable. The overall cryptocurrency market, by the way, has, it reached $3 trillion last year. Right now it's below $2 trillion, still very much below the equity market, which is about $50 trillion. But in terms of activities, transaction volume, it's actually way bigger, about 10 times bigger than what we observe in equity market. It's in between Forex market and equity market, which reflects its hybrid nature as an asset. Okay? Anyway, that's one type of staking. A second type of staking would be DeFi staking, staking that's happening in the DeFi space. MakerDAO is an example where you can pretty much stake or lock in ethers, and get a stable coin, DAI, and do even leverage trading. I was discussing a very interesting paper at a conference just a couple of days ago. That's one example. For Chainlink, if you stake your tokens, you get to help with the decentralized Oracle network, where information feeding is more accurate and more secure. Right? Those are some examples of DeFi staking. In our data, we already observed 60 stakeable assets, crypto assets. There are definitely more than that, given that we already observed 60 of them. And they cover all the mainstream cryptos as well. So many cryptocurrency, crypto assets have staking programs. And the yield or the staking reward rate on average falls in 8% to 15% range, which is really high. That's not the interest rate I can get from my bank saving, for sure. Of course, these are risky. I don't put an exact number because depending on whether we're doing value weighted or equal weighted. But that's a high reward rate. Where does it come from? In fact, it's actually coming from the subsidies many of these programs provide. That can be the long run outcome, right? Subsidies would run out. But it's very similar to how many tech firms, big digital platforms, initially acquire users. They threw subsidies into the ecosystem just to acquire users. And later on, they'll figure out how to monetize the system. In the long run, any return or any reward from staking has to come from the real value that's generated. Or fees collected within the ecosystem. That's something practitioners are actively thinking about. At least in this initial stage, the rewards that the system give out to stakers is typically pre-announced. The system is typically tells the stakers, I'm going to mint this number of new tokens, and fixing the total amount of reward. The more people, the more stakers we have, of course, per tokens reward rate will be lower, right? Because we are sharing a fixed pie in that regard. And it's quite transparent. One thing I should add is, in addition to that additional minting of tokens as reward for staking, sometimes the rewards can also come from fees collected within the system. If you are doing staking for an exchange, decentralized exchange, it could be the transaction fees that the DEX collects that's going to be distributed to its stakers in the system. Okay, so that's what I meant. Here, the lever is really on the quantity. People are typically deciding on the quantity of reward to be given out. Does it have to be the case? No, you can set the rate as well. But then how that's going to affect the overall supply and all that is going to be quite uncertain, and the market response to that typically is not very positive. That's why, somehow specifying the quantity at least appears to be more transparent and is better received by the market. In this space, another concept that we hear a lot is total value locked. That's not something we're going to cover today. I think it's very interesting, but total value locked within the DeFi involves both the native token and other types of tokens. If I'm talking about Uniswap and some sort of decentralized exchange, of course I have to lock in multiple tokens, right, in order to facilitate the exchange of crypto assets. But what we want to focus on today is really on the native tokens, how staking of native tokens affect the pricing of native tokens. And here I'm using the word tokens generically. It could be layer 1 coins as well. The data we got is from stakingrewards.com. They have generously shared and updated data in February this year. We were actually working on this 2 years ago. That's even before the emergence of DeFi. So we were looking at POS protocols more back then. Okay, and one thing I do want you to keep in mind is this is similar to depositing cash in a bank or investing in some risky asset where you earn a fixed income, right? So in that sense, it's quite related. And because of that, we're talking about interest rate, and we're talking about different crypto tokens or cryptocurrencies. Naturally, there's a concept of, currency carry, interest rate parity. These all come into play, right? If I'm allocating my assets, wealth across different blockchain platforms where they have staking program, I might be earning different reward rate. Is that more than or exactly compensated by the different difference in exchange rate across these different currencies? Is a natural question to ask, and that's something we do investigate. Okay, so let me go to the theoretical model. Depending on the time we have, I may not go into the very details of it, but I'll try to provide a basic duration. So here we are in continuous time. We have one native platform and a consumption good serving as the numerator. the platform that uses the native token has a productivity process that follows, in the baseline, we use a geometric Brownian motion. The productivity is 80. That's taken from my earlier work on tokenomics. It could be further endogenized. The drifts and all that for the process can be further endogenized. And we'll talk about that in a little bit. But safe to say, there's a stochastic process on the productivity of the platform. And that's the fundamental. That's exogenously, well, in the baseline, exogenously given, right? That's where the uncertainty, the shocks, the dynamics are coming from. What is this productivity? It could be the matching efficiency on the platform. It could be how the policy environment, the landscape is changing over time. For example, with the Biden's executive order on regulating digital assets. There's one unit measure of agents. They are all price takers. They are infinitesimal. Each one is indexed by I, and they differ in the total wealth they have, which we use WIT at time t to indicate. They are essentially solving a portfolio problem. They have to decide how much wealth to allocate on to the platform, on-chain. And that is further comprised of two parts. XT is the amount that they hold for transaction purposes, right? I'm holding Filecoin to buy and sell extra storage. So that gives me a transaction convenience. But I'm also deciding how much to stake. The amount denoted in numeraire is given by LT, that's for locking staking. I need to decide how much to hold in cash or off-chain, right, in numeraires for my consumption at time t, YT. The token convenience is specified in the reduced form following the literature. Essentially, if I'm allocating more for transactions, I get a higher convenience flow. And because agents are all different, their wealth, maybe if I'm a richer guy, run a bigger business on-chain, also derive higher utility, right? This type function, UWT, can be specified quite flexibly, only require some simple regularity conditions. And of course, if the platform is more productive, 80 is higher, I would derive more convenience flow from the platform. In order to talk about interest rate parity and crypto carry, we need to introduce a concept that's typically used in international finance. That's essentially the transaction cost and consumption. Here we use per se to denote that if you consume more, transaction cost and consumption is higher, but if you hold more numeraire, right, off-chain, that is lower. So it essentially captures the convenience of holding the numeraire as opposed to the convenience of holding tokens on-chain for activities on the platform. And the reward process can be very generally specified. It has one part that's coming from emissions, basically newly minted tokens. These are typically deterministic process that the platform or the governance body for the ecosystem announces ahead of time. There's also the part that's coming from fees. I'm using FT here to denote them. They could all be functions of the total number of tokens in supply QT, as well as the productivity as a state variable for the platform. For simplicity, in the numerical solution that I'm going to show you, we just let them to be linear in the total amount of tokens out there, right? So it's kind of fixed, constant growth. It's not too crucial. Most of the results would go through had you specified a different and more sophisticated reward process in the system. FT here is stochastic, basically. If we use tau t minus, multiplied by qt to denote the reward that's coming from fees, it's actually a random variable because at any point in time, I wouldn't know in the next period whether I'm going to collect more fees or less, right? It depends on the demand coming from the users of the platform. One important concept that stakers care about is reward rate, lowercase rt. It's the total amount of rewards divided by the total number of tokens staked. When I use capital letters, I'm really talking about the number of tokens, and when you use lower letters is for the value denoted in the numeraire. Okay, in this discussion. One could introduce a slashing cost, the running cost of the nodes for staking. It could also capture certain risk that one faces. Right? My fund might be slashed at some point. For simplicity, we're just using constant here, not constant. It could be time variant, but we just use a number to know that. In the numerical results, we're going to use a constant. It's not crucial for our main insights. Okay, it's more for realism that we introduce it. Token price is going to follow an endogenous process, general diffusion process, where drift and diffusion terms are time varying. One important concept that practitioners have not talked about a lot, but it turns out to be crucial in pricing or predicting returns of tokens is the staking ratio. It's essentially the total number of tokens locked divided by the total numbers of tokens out there in the supply. It would be similar to total value locked over, I guess, market cap for that cryptocurrency. But staking ratio is more powerful as a predictor. And that's something that bears relevance for practitioners as well if they are investing into stakeable tokens. We'll come to that. Recall, we did talk about how we might endogenize the productivity process, AT, right? One possibility is if the staking ratio is higher, the security for the network is improved, and therefore the platform is more productive. It has a higher drift going forward. And so in the latest version of the paper, we do allow this type of feedback to be incorporated into the platform productivity process. Individuals solve their allocation problem. It's essentially a stochastic control problem. We can write down the HJB equation. I'm not going to go into too much details. What is interesting in the system is each individual is solving their stochastic control problem, but the whole distribution of agents of different wealth is evolving over time as well, because depending on how I allocate my wealth, I might be earning different returns, right, across the infinitesimal DT time period. Luckily, that's something that physicists have worked on before, right? If we're talking about an individual particle following a Brownian motion, the diffusion process, the Fokker-Planck equation can characterize the distribution of articles. It's essentially a forward Komarov equation. And for that, we basically write down the Fokker-Planck equation for the wealth distribution, and we know how the whole system is going to evolve. Agents are taking reward rate as given, but their aggregate staking is going to pin down the reward rate RT. So we're solving a fixed point problem here. The mean field equilibrium is essentially agents solving their own stochastic control problem, and we know the law of motion for the system states, and the reward rate has to solve the fixed point problem I just mentioned. I probably don't have time to cover this, but you can write down the PDE for the pricing formula. It involves two state variables. It turns out that you can separate into two state variables, AT, the platform productivity, as well as the number of tokens supplied, QT, and solve the ODE instead. What are the relevant boundary conditions? When the platform becomes useless, AT goes to 0, the value of the ecosystem should be 0. Right? When the platform becomes infinitely productive, AT goes to infinity. Basically, all the wealth agents have are attracted to the platform. Okay? So it's essentially the valuation of the platform should be equal to the total wealth in the economy. Okay, those are the boundary conditions. You can solve this, and there's a number of predictions that the model would generate. For example, higher staking ratio mechanically is going to reduce the reward rate, right? Fixing the total reward, more people staking means each one is getting a lower reward rate. What is interesting is that the staking reward ratio defined by total amount staked divided by total number of tokens in circulation is positively correlated to the staking ratio. So if the staking reward ratio is higher, the staking ratio is higher. There are more rewards there, more people will stake. So that's also quite intuitive. What is quite non-trivial is number 3. Higher staking ratio actually predicts higher price appreciation in the system. And that leads to the violation of uncovered interest rate parity. Right? And uncovered interest rate parity would say, well, if I'm getting a higher reward rate, presumably my token price appreciation relative to the numeraire relative to other tokens should be lower. But that's not the case. If I'm actually getting a higher staking reward rate, my token actually also appreciates more in terms of future prices. And we plug in a number of reasonable parameters in order to solve this completely numerically, right? Solving the PD and OD numerically. And here, the dotted line I'm showing you here is the fixed point equation. And the blue line here is the aggregate staking ratio plotted against the reward rate. So higher reward rate will have higher staking ratio. The wealthier individuals are more reactive to increasing reward rate initially. And here is how staking ratio predicts expected price appreciation. What is the intuition here? I actually plot both the dynamics with feedback effect and the one without feedback effect. But overall, there's a positive association. Why is that? Just think about the productivity process 80. When 80 is small, that means more wealth is still off-chain. That means the potential for more wealth to be reallocated on-chain is higher. And what happens when wealth is allocated more on-chain? There's going to be greater demand for the tokens, right? For any given supply. That is going to push price up. So in that sense, low productivity of the platform corresponds to high mu. Low platform productivity also means, when the agent is indifferent between allocating marginally more to transaction, holding the tokens for transaction versus staking it for reward. If the platform productivity is low, the transaction convenience is lower. Therefore, agents are more willing to allocate it to staking. That's when the staking ratio is also high. So that's why the two are positively correlated. The feedback effect also pushes the price appreciation higher, which is not surprising, right? The higher staking ratio I have, the more it feeds back to the drift of the platform productivity. And the trend in platform productivity is going to affect how token prices are going to appreciate, right? For a given supply of tokens. Of course, when I distribute rewards, I'm minting more tokens. So there is what practitioners would call inflationary pressure when we are giving out staking rewards. But it turns out as long as it's within a reasonable range, overall effect for staking is still positive on token price appreciation. And it's not too surprising because when you stake tokens, a large quantity of tokens are actually locked out of the circulation. Right? To clear the same amount of business transactions measured in numeric terms, now I have less tokens in circulation to do that, fixing the velocity of tokens, each token has to be worth more in order to clear all those transactions. So that's quite intuitive, I would argue. So we do test the predictions of the model in the data. We have observations from staking rewards, more than 60 stakeable tokens. Originally, we only have the data covering until August 2020, but as I was mentioning earlier, we were able to update the data. So it covers a wide range of major POS protocols as well as DeFi projects. Why these 60? These are the ones that are ranked high in staking on the stakingrewards.com website, and it's essentially based on their market cap. So these are the largest, most influential DeFi projects and cryptocurrencies. In the paper we provide more results, but here very quickly, the staking reward ratio is positively associated with staking ratio, right? That's one of the prediction. Using the full sample or using the earlier sample we had until August 2020, that's the pattern we observe consistently. And if I try to use the staking ratio in the previous period to predict price changes and returns over daily horizon, weekly horizon, or even longer, I do observe strong predictive power of the staking ratio. Remember the capital theta. After controlling, say, changes in network growth, the size of the cryptocurrency, and even the kind of crypto market index. And you can add in fixed effect for tokens and so forth. So that's quite robust. In terms of interest rate parity violation, if we use Fama's well-known test from 1984 paper, if UIP holds, we shouldn't see a significant beta when we regress the kind of token price appreciation on the interest rate differential between domestic and foreign currencies. We can do that for each currency we have, US dollar, Bitcoin, or any of these tokens, and UIP is violated. Basically, you observe a negative beta. And from that, you can actually borrow the concept of carry from, for example, Ralph Gosser's paper, and define a crypto carry. And once you define this term, it actually can help you form portfolios of either long short or long only carry strategies, carry trade. And it turns out that annualized return on everything is pretty high. Part of that is coming from the fact that the whole crypto sector has been growing, right? So if you're doing equal weighted of any token, you would have experienced a high return. But what I'm going to show you is even for long short strategy, the Sharpe ratio is 1.61, which is pretty high. Okay. And here is just the cumulative return of 1 week carry trade with the staking, or you can do carry trade without using them for staking, right? And what we observe is the cumulative return over just a short horizon of 3-4 years is actually rather significant. You can focus on the top 50% of high carry assets and do long only, just to compare it with the overall market. It earns substantial additional return over the market. Okay, so that's what I have for this particular staking paper. I think there's a few dimensions that will be interesting to explore further in future studies. For example, how do we go from subsidies to using fees collected within the ecosystem to finance the rewards for staking programs? That's an open question. Many entrepreneurs are struggling with that. So that would be interesting. And overall, staking is really adding a utility to the second category of tokens, right? Platform tokens. One utility is you can use it as local means of payment on the platform, but now you can use it for staking and earn a reward. And you can think about other utilities such as governance and how we should price these utilities is also something very much open for exploration. And here, if the staking level is high, presumably it feeds back to the network security. We capture that by allowing staking ratio to feed back to platform productivity process. There are other ways to incorporate this type of feedback. It could go the other way as well, right? So if the productivity process is higher, presumably more people would come and stake. Okay? Wealth distribution from staking is interesting. Our model actually allows you to back out the overall wealth distribution from on-chain wealth distribution. So what we observe as concentration and all that on-chain may not necessarily correspond to the overall wealth distribution, because agents could have heterogeneous risk tolerance, and they have different portfolio problems they're solving. So it would be interesting to think more about how the wealth or even income distribution within a certain digital ecosystem would correspond to individuals' overall wealth distribution. And this particular study as to the literature on blockchain and DeFi and token pricing, and it's also closely related to international finance in terms of UIP violations and carry trades. And by the way, the reason UIP is violated is really coming from the convenience flows, right? Both from holding the numeraire as well as from holding the tokens on the platform, where you can derive transaction convenience. Okay, so in the I'm happy to take some questions, but let me just spend a couple slides on kind of why we observe this development of Web3 and DeFi, and also to tie that to monetary policy. Right? For staking, you can already see this is related to the monetary policy of the platform. How I'm going to give out rewards is a monetary policy decision. Right? If the reward is higher, of course, I'm distributing wealth to the stakers. But if I increase the total supply of tokens, that's inflationary, right, for the whole ecosystem. Inflationary in terms of the practitioner's language. I think, strictly speaking, economically, inflation has different meanings. But we know what we mean there. If we increase the supply, token prices could depreciate, right? The price could go down. So that's hurting everyone. That's a redistributionary exercise in terms of monetary policy for the ecosystem. And overall, many advocates for DeFi and Web3 would quote financial inclusion and financial democratization as justifications why we want decentralized system, why we need decentralized finance. Is that actually happening in these ecosystems? Internet, sure, Eco Market, they have a very interesting paper just describing the ecosystem for Bitcoin, right, in terms of distribution of ownership, mining rewards, so on and so forth. My co-authors, Ketang, Yanxin, and Xi, we've been looking into the Ethereum ecosystem, and we do two things in this ongoing study. First, we just describe the ecosystem in terms of distribution of ownership of ETH, in terms of the mining income for ETH, even though Ethereum is transitioning, hopefully transitioning into POS, but right now it's still proof of work. So there's POW mining ongoing. And also the distribution of transactions. If Web3 is really helping with financial inclusion and democratization, we should see some more equal distribution in terms of ownership, income, and more importantly, we should see small players also being quite active in the ecosystem. Unfortunately, that's not quite what we observe. Let me actually show you the next graph first. This is the distribution of ownership based on individual wallets and addresses over time. You can see over time, concentration is going up. The caveat is ownership of ETH doesn't necessarily mean ownership, overall wealth distribution. Right? So, and the ETH price is fluctuating relative to other assets that the individuals hold. So we will take this with some caveat. But nevertheless, in terms of mining income distribution, in terms of ownership distribution, is highly unequal. So that's what we observe. More importantly, if we look at the amount of smart contracts being executed, the value of Ether or top layer tokens being used in these transactions, or if we just look at the number of DeFi transactions, it's heavily concentrated among large transactions. Here I'm using US dollar, so bigger than 1,000 US dollar. And horizontal axis is the percentage of transactions. So no matter how we look at it, small players are not very active. And that's not too surprising. If you look at the fee mechanism in Ethereum, originally it's using first price auction, individuals bid gas fee to have their transactions put into the next block. The EIP 1559 that took place last year changed this a little bit. They'll burn certain amount of base fee in terms of ETH. And it's just burned. And what is burning is sending it to invalid addresses that can never be taken out. So the tokens are taken out of circulation. Okay? And that's a deflationary action. But no matter which one I look at, the gas fee is not based on the amount of the value of transaction. So for someone buying a coffee versus someone buying a whole house, each computation in the smart contract would cost you a similar base fee. So the fixed cost is substantial and is the same for both large and small players. That means the larger players are going to utilize the system more, right? Because as a percentage of their overall transaction, fees are pretty low. Whereas smaller players, I wouldn't be using Ether or Bitcoin to buy a coffee if the transaction cost, the fee is really high. So that has led to this financial exclusion, actually. But not all hope is lost. There are things that are improving over time. And one of them is actually EIP 1559 itself. When you burn the base fee, what you're doing is, and that's something we observe in the data, you are taking the fees from the large players, right? Because they are the more active players in the ecosystem in terms of transactions, and burning them. And when you burn them, it's distributed to all ETH holders. So that benefits smaller players as well. And we do see when EIP 1559 was introduced, smaller players have a more significant increase in terms of transaction amounts, so on and so forth. Remember, the base fees were originally going to the miners. So now they are burned. So this also represents certain fees taken out of the miners and redistributed to all token holders. That also mitigate the concentration of mining income quite a bit, and that's something we empirically find. Another interesting phenomenon within these DeFi projects is airdropping. And if we think about it, it's also a redistributive action, right? And by the way, all these are related to the monetary policy of the ecosystem. When I'm airdropping, I'm minting new tokens, I'm increasing supply, and I'm dropping it to a select set of agents within the ecosystem. So that's a redistribution, because if I'm increasing supply, every token holder is hurt, but only a small subset benefits if they receive the airdrop tokens. We use one case of Omisco airdropping. That was a major e-commerce payment token introduced in 2016, 2017, but the airdrop happened in 2018. Basically, if you have the amount you get in terms of OMG token is proportional to the Ether token you have. But we're minting new OMG tokens. So the minting would hurt bigger holders of OMG, right? And as long as the holding of ETH and OMG tokens are not fully correlated, we can see this is a redistribution. And it turns out that the smaller OMG holders benefited proportionally more disproportionately more when the airdropping was taking place. And there are other airdrops that you can see. We use a definitive with propensity score matching, so on and so forth. So we have more details in the paper, but I just want to mention, right, these are all kind of related to monetary policy, not the optimal design, but especially if you have a monetary background, I think this is a very exciting area to work in. And also if you are someone who's been working in mechanism design, how to think about designing these systems to ensure security of the system, low cost, and also decentralized structure will be very important. I'm going to end on a note of that decentralization, right? Why do we want a decentralized system after all, right? I already mentioned financial inclusion, democratization is a driver, but overall there are pros and cons to centralized versus decentralized system. A decentralized system could potentially prevent what I would call single point of failure. Basically, if you are using a cloud computation and if the cloud server is stored in a particular region prone to natural disasters, then a natural disaster could wipe out your files and storage. But if it's distributed into multiple database and distributed, it's less prone to single point of failure. Of course, it's not free. Distribution and replication takes time and effort and financial resources. The single point of failure could be economical in nature. It's a lot easier to bribe a single judge in a lawsuit case than bribing a whole panel of judges, right? So certain decentralization helps. Decentralization is also helping with reducing the intermediary rent of intermediaries. So it's not disintermediation, but it's actually encouraging more open competition among potential intermediaries. And therefore the fees that users have to pay, consumers have to pay, can go down. No single individual intermediary, for example, in Bitcoin case, have any dynamic market power. Each round of block generation is a new tournament. And you have to mine and solve these cryptographic puzzles in order to win the right to record keeping of transactions. So I'm going to stop here. I know I promised to take potentially some questions from the audience.
Thank you very much, Professor Cong, for a very broad and, well, both breadth and depth in your talk. I think we have Professor Yan who has a question, raised his hand.
Hi, William. Thank you very much for your talk. It's enlightening. And I'm interested in since I'm working with this AI-powered fintech. In particular, we are working on some supply chain finance projects. And I'm interested in this mechanism design issues. In your talk, you talked about this, the token and the size of the token or supply of the token. And I think, if you want to increase the supply using your example, coffee probably is easier, and houses may not be that easier at least in the short-term run. So can you elaborate? What are the sort of things which in the mechanism design and the size of the token, which is also related to your staking side? Can you elaborate a little bit on that regarding?
Absolutely. So I'll mention two items that I think are pretty interesting related to mechanism design. One is something people are already exploring. We do face certain impossibility trilemma in either base layer design or a higher layer design. Basically, if we want decentralization, we want security and functionality, and we also want capacity at the same time. It's actually a pretty hard problem. That is hard for base layer. That's also hard for any decentralized network. If you think about decentralized Oracle network, right? It's essentially a peer prediction game. How do you make sure people are in a more decentralized system, how people are incentivized to do the right thing. If everyone is reporting the wrong information and I report the same wrong information, I might be rewarded, right? Even though that's not the truth that we would like to see in the ecosystem. So I think just working out the game theoretical equilibrium and figuring out the optimal design to achieve these objectives would be very interesting. I personally have been exploring that a bit, trying to introduce reputation systems back into static incentives that we typically observe in blockchain. Another dimension related to what you mentioned about the scarcity of, let's say, house supply. One interesting link one could make is we can tie the supply or the minting of tokens to certain scarce resources. That's one way to discipline the supply side, right? I mean, why people say, oh, Bitcoin is great, it's deflationary, it's better than money. Well, because the supply has a fixed rule, it's going to decrease over time. It's, block rewards are going to be halved every 210,000 blocks, something like that. But that's just an algorithm. That's just an ad hoc specification by Nakamoto. Wouldn't it be interesting to tie it to some scarce resource, such as land, such as other physical assets? I think that's also a very interesting area to explore. I think it's very much related to what you were saying about house.
Okay, and just a small further question: if this supply, the token supply, its parameter one wants to optimize, what is going to happen to your HJB equation, and whether the result you reported, still hold?
Yeah, so we did a number of robustness along that dimension. The basic insights would hold. The exact shape might change over time. I think the basic insights also shows up in international finance, right, or even commodity market. So in that sense, it's quite general, but it's good to kind of derive it in the crypto space and verify in the data. And I think there's also a question from Bofu in the chat box, whether do we consider LP staking or just single token staking, and do we consider impermanent loss? So far we haven't. We are focusing on single token staking. I think multi-token system will be very interesting to explore. As far as I know, I haven't seen an academic study on that, but that's happening in practice. Many protocols do lock in multiple tokens.
Thank you.
Thank you very much.